Businesses have money flowing in and flowing out at all times. Whatever their long-term financial position, they always need short-term finance to keep the business running, to pay their short-term debts. Money is like oil in an engine. Without it, the engine seizes up. Another term for short-term finance is working capital. Another term is net current assets. By this we mean current assets, cash in the bank and those assets, such as money owing to the company, that can be quickly turned into cash, minus current liabilities, those bills the company has to pay out in the near future. One important point: working capital is not the same as cash in the bank. You have to take into account monies owed and owing. The bank balance may look good one day, the next there could be heavy bills to pay. So all that must be accounted for too. Many businesses, even profitable ones, suffer from a lack of working capital. They may have too much money tied up in fixed assets, such as machinery or buildings. They may be too slow in chasing up the money owed to them from their debtors. So obviously chasing up money owed is good. Possibly even restrict credit terms to your customers or charge interest on late payments. But not everybody is keen on being too hard on debtors. The marketing department, for example, who want to keep their customers sweet.
We have to be careful not to alienate our customers, so therefore not to be too strict, too quick to start charging interest or threatening legal action and that kind of thing. The most important thing for us is to maintain our customer base and not to encourage them to go to our competitors. So it's a very fine balance.
Another possibility is to outsource debts to a factoring agency that will chase them up for you. But of course they'll charge a commission. On the payments side, longer payment terms from creditors may be another way of maximising working capital.
We just need you to pay the money. That's all we need.
Some companies take longer to pay whether it's agreed or not. It's one way of increasing working capital, but there are dangers.
We just need that invoice paying.
Yes, you might increase your working capital, but what is the cost in terms of goodwill? You need goodwill from your suppliers, and you might lose it if you're always late in paying. Negotiating different terms, now that's completely different.
VIII is the company accountant with Logical Friends, a computer supplier. That means she's in charge of credit control.
I want our money sitting in our account, not sitting in their account. There aren't very many late payments because I'm on the ball, and I get the invoices out straight away, and they've only got their little period of time to get them back, and they do get them back generally. It's important to have a good working relationship with our customers, but at the same time they know that they've had a service from us and that service has to be paid. And I can put that across to them in a way that isn't offensive, but actually they know that I'm in the right. It's just a matter of them getting their act together. Yeah.
And keeping costs down increases working capital and profits. Of course, it shouldn't be done in a way that reduces quality. Reducing unnecessary costs, on the other hand, is always important to a business. Too much working capital? This is a good problem to have, but sometimes it happens.
Companies that have too much cash could be missing an opportunity. That cash might be put to better use growing the business, and therefore they'd get a better rate of return than money that they just have sitting on deposit in a bank.